You're halfway through a second espresso when a friend whispers the phrase that makes every Spain-based expat sit up a little straighter. Modelo 720. Don't panic. This isn't a tax bill. It's an information return where Spain asks residents to list certain assets held outside Spain once those assets cross specific thresholds. Get it right, and nothing dramatic happens. Get it wrong, or forget to file, and you invite letters you don't want and penalties you didn't plan for. Start with the only question that really matters at the door. Are you a Spanish tax resident for the year the assets existed? If yes, Modelo 720 might be your chore. Spain decides residency using facts, not captions. Spend more than 183 days in Spain in a calendar year, keep your spouse or minor children here, or genuinely anchor your life and economic base here, and you're usually in. Non-residents with a holiday flat on the Costa or a sabbatical in Seville without crossing residency tests don't file Modelo 720 for that year. Residents do. If you are resident, the second question is what you own outside Spain at 31st December. The declaration is split into 3 big asset groups, and each has its own €50,000 threshold. Think in boxes, not items. Box 1 is bank and deposit accounts, current accounts, savings, time deposits, held at foreign banks. Box 2 is financial assets and rights, shares, bonds, funds, life insurance policies, and lifetime or temporary annuities when the custodian, insurer, or manager sits outside Spain. Box 3 is real estate and rights over real estate, flats, houses, land, and bare ownership or usufruct located outside Spain. The rule is deliberately simple. If the total of one box is above €50,000, that box is reportable. If it isn't, you skip that box. It's a per-box threshold, not a grand total. Inside each box, Spain also wants the story to be specific. For foreign bank accounts, you'll report the bank, country, account number, the balance at year-end, and the average balance for the fourth quarter. For shares and funds, you'll identify the security, the company or fund, the number of units, the custodian, and the year-end value. For life insurance and annuities, you'll give the insurer's details, the policy or contract number, and the surrender or actuarial value. For real estate, you'll show the address, type of right, acquisition date, and the purchase value. If you're a joint owner, you still report. The declaration shows your percentage. If you closed an account or sold a foreign property during the year, that event itself can make the box reportable, even if the ending balance is 0, because Spain wants to see closures. Here's the third part most first-timers miss. You don't file every year forever. You file the first year a box crosses €50,000. After that, you file again for that same box only when something material changes. In practice, that means the total value in that box goes up by more than €20,000 since the last declaration, or there's a change in ownership, or you close or cancel an account, security, policy, or property right. If nothing material changes, you don't refile that box. It's not a ritual, it's a trigger. Deadlines are kinder than rumors. Modelo 720 covers assets as of 31st December and is filed the following year, typically by 31st March. It's online only through the Agencia Tributaria portal using a digital certificate, CLOVE, or a representative. Treat the deadline like a flight time, not a vibe. Spain's tax servers are always busiest the last week of March. I tried at midnight is not a legal defense. Now the part you may have heard at dinners. The penalties. Years ago, Spain attached brutal fines to this form. Draconian surcharges, quasi-permanent audit windows, and a 150% penalty that the European Court of Justice ruled disproportionate in 2022. After that ruling, Spain toned the regime down. The obligation to report survives, but today, the penalty landscape looks more like the regular Spanish rulebook. Standard late filing surcharges that scale with delay, fixed penalties for missing or incorrect data in an information return, and the normal 4-year statute of limitations replacing the old endless shadow. The headline is calmer but not toothless. Fail to file or ignore a request, and you can still pay a meaningful, if more measured, price. File late voluntarily, and you generally face surcharges instead of the old sledgehammer. The lesson is simple. The era of ruinous Modelo 720 fines is over. The duty to file isn't. Just when the dust settled, crypto stepped into the room with its own form, Modelo 721. If you are resident in Spain and hold virtual currencies with foreign custodians above an initial aggregate threshold, think the same spirit as €50,000, you now have a separate, crypto-specific information return, debuted for 2023 data. The idea mirrors Modelo 720. Disclosure, not tax. If you self-custody, watch the technical definitions. If you use foreign exchanges, you're likely in scope once your balances cross the line. The filing season runs alongside 720's spring window, and the same material change logic applies in subsequent years. Public explainers and news briefings from the last 2 seasons outline the thresholds and deadlines. The tax agency's notices and Spanish press have been blunt. Crypto abroad is firmly on the radar. So who exactly must file? Picture a few lives. You're a Brit who moved to Valencia in June, became resident in your first calendar year, and kept a €70,000 ISA and a €10,000 current account in London. Your accounts box stays below 50,000. Your securities box crosses it. You file the securities box by March, skip the accounts box, and forget the real estate box because your UK flat sold years ago. Or you're a German family in Madrid with joint Swiss accounts totaling €120,000 between spouses. You file the accounts box showing your percentage on each account. Or you're a marketer in Malaga with US brokerage funds around €45,000 and a small condo in Lisbon you bought for $180,000. You skip the securities box, file the real estate box with purchase value and details. Or you're a tech consultant in Barcelona holding 12 BTC on 2 foreign exchanges plus a hardware wallet. Your coins at foreign custodians cross €50,000, so you pick up Modelo 721. Your self-custody may be out of scope for that form, but if you hold other foreign assets above threshold, 720 still speaks for those. In each case, the logic is mechanical, and the form is patient. Boxes, thresholds, details. Done. Documentation is your superpower. For bank accounts, keep year-end statements and the running balances that prove the Q4 average. For securities, download your year-end portfolio reports. If you hold life insurance abroad, keep the policy statement that shows the surrender value. For real estate, file your purchase deed and closing adjustments in a folder called Foreign Property, Spain, even if you've owned the place forever. For crypto, export balance confirmations and historical value snapshots from the platforms you use. If joint ownership or trusts are in play, keep the legal instrument that proves your percentage or role. None of this is dramatic, and that's the beauty. The more boring your evidence looks, the more believable it is. What about common tripwires? The first is assuming the threshold is per asset. It isn't. It's per box. 3 small foreign accounts that add up to €60,000 are reportable, even though each is below 50,000. The second is ignoring closures. If you shut a foreign account during the year, you report that closure the first time it happens, even if your year-end balance is 0, and even if you never crossed 50,000 before. The third is forgetting that life insurance and annuities sit in the financial assets box. People remember shares and funds, but miss policies that quietly carry value. The fourth is mixing residency years. If you became resident this year, you look at this year's 31st December, not last year's. The fifth is waiting until the last week of March to find platform statements. Websites change, logins expire, and customer support is not a time machine. Penalties, even in their reformed version, still care about attitude. File late on your own, and you'll meet the standard Spanish late filing surcharges that increase with time but fall if you pay promptly. Ignore notices, and you invite fixed penalties for missing or inaccurate information returns. Misstate cost or value on purpose, and you risk the sharper end of Spain's general sanction rules. The horror show headlines of the past belong to the past, but complacency is still expensive. Public guidance now routinely quotes penalty bands in the hundreds to low tens of thousands for failure to file, depending on scope and stubbornness, not the 6-figure nightmares of old. That's a meaningful relief, not a free pass. There's a quiet, useful side effect to getting 720/721 right. Your regular income tax return gets easier. If your foreign accounts paid interest or your brokers paid dividends, those are taxable in Spain when you're resident, usually with a credit for foreign withholding up to Spanish tax on the same item under a treaty. If your foreign property was rented, that rent meets Spain too. Again, normally with a credit for tax already paid abroad. The information return doesn't compute tax, but the documents you collect to file it, the statements, policy values, deeds, double as the proofs that make your annual return coherent. When numbers on one form talk to numbers on another, examiners relax. That's the feeling you want. What if you discover tonight that you should have filed last year and didn't? Breathe. Fix forward. Start by downloading every relevant statement for the missed year and the current one. Prepare this year's declaration on time. For the missed year, speak to an advisor about a voluntary late filing with standard surcharges rather than waiting for a letter. In the post-2022 world, coming in clean matters. You won't rewrite history, but you can write the next chapter in a calm tone. Modelo 720 is an information return. It doesn't by itself generate Spanish tax. It tells Spain what you own abroad. If those assets produce income, Spain taxes the income under normal rules, not because you filed the form. If you later sell and make a capital gain, that's handled on your regular return. The form doesn't make you double pay. Treaties still exist. If your dividends from the US suffered 15% withholding under a treaty, Spain credits that against its own savings income tax on the same dividends when you report them, up to the Spanish amount. The information return and the income return are two parts of one story. Write both. Open a folder with the year in its name and 3 subfolders: foreign accounts, financial assets and policies, foreign property. Drop year-end statements, policy values, and deeds into the right homes. Add a 4th folder called Crypto, Foreign Custody, if that's you. Make a 1-page note that answers 5 simple questions. Am I resident this year? Which boxes cross 50,000? Did anything close, change owners, or rise by more than 20,000 since my last filing? Do I have crypto on foreign platforms above the crypto threshold? What's my plan to submit by 31st March? When everything fits on that page, log in and file without drama. You don't have to love these forms. You do have to respect the cadence, boxes, thresholds, details, deadline. In exchange, you get the grown-up peace of mind that the spring brings no surprises and the autumn brings no brown envelopes with bold fonts.